Good evening, everyone, and welcome to Home Buyers Connect, a consumer awareness initiative from HomeCapital. This is our first webinar, and we'll be organizing many more on a monthly basis, covering a wide range of topics in the home buying process. As pioneers of India's first home down payment assistance program, it gives us immense joy in helping accelerate the home buying journey for everyone. Today, for this session, we'll be discussing how a home buyer can prepare or maybe even perfect their credit score before availing a home loan. A credit score is extremely critical today in the digital lending landscape since it literally acts like a passport to credit. We've got we've got digital lending expert Mr. Parijat Garg with us, who has been in the credit business for well over a decade. He has served as CRIF India's senior vice president, and you may have come across his expert views in many newspapers and online publications. Thank you so much for joining us, Parijat. How are you?
Very good, and my pleasure to be here.
Thank you so much for helping us kickstart this Home Buyers Connect series. I'm pretty sure it's going to be very beneficial for a lot of users since navigating the real estate market is quite a Herculean task, and plus you also have to find a property, negotiate, and then you have to deal with banks for home loans. So, yep, very glad to have you here.
It
We'll just
it is
start.
indeed. It is
Sorry.
indeed. Like I've gone through it myself a couple of times, and it has always been an Herculean task.
Right. And there are so many technical terms involved in the process that it in itself becomes quite overwhelming.
Yes, it does. And I must congratulate you guys to start this Home Buyers Connect and an education initiative, which can help a lot of first-time buyers to understand the nuances and make sure that they are prepared. They're not getting trapped into things that they do not want to get trapped into.
Right, right. In fact, that is the primary motive over here to, clear out the clutter and make things as easy and simple to understand. I mean, yeah, even I'm quite new to the property market, and even for me, it was not really a very difficult learning curve once you sit down with the information you have, and when experts are there to basically help you out. So we are hoping that, we can extend a similar platform to all our other users. So,
Sure.
since today our primary topic is about credit scores, my first question is going to be very basic. What is a credit score and why should one take it seriously?
I think Shivam, you kind of summarized it very well that credit score is almost like a financial passport that everyone should be having and taking care of as much as we take care of our passports. So this is nothing but like a number, a mathematical number, which is a three-digit number that banks today use as a reference point to understand a customer. And let me just take a digression here. Like when we take exams, then by looking at the result or the answer sheets, a teacher understands exactly how we have done on a particular subject. Now, for a bank to know how an individual is when an individual is applying for a loan, they do not have any understanding of person's background. This credit score and behind that the credit report and the credit history is nothing like a report card of what kind of loans you have taken, what kind of credit cards you have taken, how you have used them, how responsible you have been in using them, and presents that picture to a bank which who's evaluating you for a loan. And that's why this becomes really critical for people, especially when you're looking for home loan as a product, because that's one of the largest decisions, financial decisions one take in their lifetime.
Right, right. So now my second question would be obviously, what are the factors that basically help us determine how the credit score is behaving?
So credit score, as like in India, is right now in this 300 to 900 range, where 900 is supposed to be the best possible credit score, and 300 is the worst possible credit score. And this is where the entire population of the country fits in. Now, credit bureaus deploy variety of algorithms to calculate the score, and the main factors that come in are four. The topmost is the repayment history in terms of how have you been paying on your past loans? Are you paying that on time? Did you pay it 1 day late? Did you pay on your EMI 30 days late, 90 days late? How many times did you miss your EMIs or credit card payments in last 1 year or last 2 years? So that is the repayment performance, which almost contributes 35% to the score. The second one is in terms of what kind of loans a person has. In like whether you have secured loans, unsecured loans. This is called debt mix. So home loan, car loan are generally considered as secured loans. Personal loans, credit cards, consumer loans, these are considered as unsecured loans. Typically, one should have a more secured mix in their loan basket, and that definitely gives you more benefits on your credit score. The third one is the utilization on your credit. This is a little complicated to understand. So, for example, if my credit card limit is 3 lakh rupees, how much of that limit do I use on an average? What is important is that this 3 lakh is the maximum credit that is available to me on my credit card. It does not mean that I should be using it every now and then. It is just the maximum available for emergency or for cases where I really need to use it. But more often than not, one is expected to use just about 30 to 40% of this limit. So if my limit is 3 lakh rupees, generally my monthly expenses on credit card should be under 1 lakh rupees. And if I do that, then that has a positive impact on credit score. And the fourth one is in terms of how many times do I apply for new loans, new credit cards? How frequently do I do it? And if I do it more frequently, the credit bureau, which does the credit score calculation, tends to believe that the person is desperate to take loans. Person is not able to manage financials, personal finance very well. And that is where it starts to negatively hurt your credit score. So these are like top more four factors that really define one person's credit score.
Right, right. So, like you said, the fourth point, I think, the amount of inquiries, basically, the number of inquiries there are, the more hit your credit score takes, because basically for the financial institution, you're being credit hungry. So,
Right.
what is the best approach to go about here? I mean, so if I install an app, let's say like One Score or Paisa Bazaar, just to check what my credit score is that inquiry also counted as an inquiry?
So it's a great question and it causes concern to a lot of people. So whenever someone checks their credit score, that is called inquiry. That's the term that is used. Now, inquiry can be of two types. One is called hard inquiry, and second is called soft inquiry. Now, hard inquiry, as the name suggests, leaves a footprint on the credit profile of a person. And this is when a bank or an NBFC checks your credit score for a specific loan application. And that is where there could be a potential impact on your credit score. The second one is a soft inquiry, which is usually done to check your own credit score for maintaining your credit score well, understanding your credit history, making sure that your credit profile is not having any errors or any discrepancies. So when we look at apps that you mentioned, these apps typically go in the second approach, which is soft inquiry. And that's why, as a user, if I use any of these apps or if I directly go to the credit bureau to pull my own credit score, in that case, since it's a soft inquiry, there is no impact on the credit score. And that's why I can check it even on a everyday basis just to make sure that my credit score remains good.
Right, right. So, my next question would be, I've noticed that my credit score is never static. I mean, even if there are no new inquiries, or my utilization hasn't changed, or I haven't even availed a new loan, but the credit score on a monthly basis is constantly going some points up, some points down. It's constantly dynamically floating. So why does that happen? And should a user be concerned about that? That hey, my score took a 10-point hit, or suddenly just climbed 50 points, but again came down by 25.
I think this is one of the biggest challenge or one of the biggest question, the common question that I hear from wherever I interact. And one of the credit score by itself is dynamic. I think that's the first point everyone should understand. And why it is dynamic? Because as we spoke about the reasons or the main factors that go into credit score, the topmost factor is the repayment performance. Now, if my loan is being repaid every month because I'm paying my EMI, if I'm paying on my credit card bills every month, then my credit score should factor that in, and therefore it has to change. That's uh, the reason why it is dynamic. Now,
Right.
what happens is that if I miss payments, it could see a decline. If I am a more consistent payer, it might see a marginal up or increase on the score. The point of the matter here is that one should not worry about such movements because it's almost like stock market which moves few points there and there on a daily basis or on every few seconds basis. But what should matter is that are you on the right side of the cutoff that most banks or lenders look at when approving a loan? As I mentioned, 300 to 900 is the range, and most banks today approve any kind of loan application with a score of 700 or above. And so, if your score, irrespective of the daily movements, is clearly above 700, you should not really worry about it because that would be just the nature of algorithm, nature of data that is flowing in. And if you are following the right practices, you will stay on the right side of this cutoff. But if you are on the borderline, then you have to be extra careful because if you are just say 705, then a minor mistake or a minor blip could really take you down to 697 and you could be on the decline side of a loan application. So that I think is the reference point one should use.
Right, right, right. So again, perfectly put. I mean, that the next question that popped up in my head was that if someone is borderline close to the 700 threshold, and let's say I'm thinking of buying a house in the next 1 to 2 years, so what can I do to ensure that that margin that I have is sufficient enough, and I'm able to ensure that over the next 1 year or 6 months, my credit score climbs up.
So I think home buying is a very uh, strenuous effort and it starts well in advance. It is not an impulsive decision for most of the people. So when you start thinking about buying home, that's the point where you should also, or maybe even before that, you should start thinking about what is your credit score today is and what your target credit score should be. Generally, there are benefits associated with credit score, higher credit scores, and especially more so in home loans. So if you are on the borderline, say around 700, when you're deciding to take a home loan, you would have few months ahead of you, and one should start practicing the things to make sure that the credit score usually goes up by making sure any of the factors that we spoke about do not really have a negative impact. So if I have to maybe leave out the two or three tips, then one would be that if you have any loans or credit cards running, make sure that you are paying them on time. Many people revolve their credit card dues. If I spend, say, 10,000 rupees, minimum amount due could be 500, could be 1,000 rupees. I just pay that and revolve the rest to the next month. If you are looking at buying house, it is better that you maintain a discipline for yourself where you are paying everything in full. That could be the first piece.
Hmm.
Second is do ensure that you're checking your credit score at least once every 3 months to make sure your score is being maintained at that threshold or is going up. If there are any discrepancies, any errors, anything that you see on the report which is not aligned to the reality, you should immediately raise a dispute with the credit bureau and the respective lender and make sure that that gets fixed, because that process sometimes could take 4 to 8 weeks. And that correction definitely should improve your score, but you should have that window available with you. The third thing one should do is that, which I talked about, the credit card utilization. Whatever limit that you have on your credit card, collectively, if I have 3 credit cards put together across them, my credit limit is say 5 lakh rupees, then I should be spending not more than 30 to 40% of that limit on an average basis, just to make sure that my score is showing positive trend. So these are, I would say, the
Right.
3 main things that one should look at.
Noted. So again, that brings me back to the home loan question again. So how does your credit score help determine what is the home loan rate? I mean, a home loan is a very big ticket financial instrument. I mean, I have to pay it over like 15, 20 years. So even a 0.1% change in the interest rate can have total accumulated savings in lakhs. So how does this
Absolutely.
work out? I mean, how do lenders go about determining basis of the credit score, what should be the interest rate?
So, as you rightly said, home loan is usually one of the largest ticket size purchase in anyone's lifetime, right? And maybe you might buy televisions, you might buy car, you might buy mobile phones, all put together. You might still be spending about 20 lakhs, 30 lakh rupees, depending on, of course, the type of car that you take. But a home loan itself, especially like in a city like Mumbai or Delhi or any of the metropolitan cities, could easily inch upwards of 1 crore. And in such scenarios, that's a very large value item. Second, it's a very long tenure item. You would take 1 crore loan or a 50 lakh loan, and it would run for a minimum of 10 years. It could go up to 20, 25 years. So the value of a home loan is really critical. And as you rightly said, whatever savings that you can do on the interest rate when you take home loan would really give you large savings in terms of the total cash outflow that you have. And many banks today and the lender housing finance companies, they have linked their interest rates to the credit score of the applicant. And say, for example, if your score is 800 plus, you might get a 20 basis point discount on the interest rate. So 20 basis point would mean that if the prevailing reference interest rate is 8%, you might get it at 7.8. And that could be a huge saving when you look at a longer tenure and a large ticket purchase. Similarly, like there could be a different rate for 750 to 800 bracket. There could be something which is 725 to 700. So one value of credit score is that you are on the right side of it, so your loan gets approved. The second thing is that if your loan gets approved at a better rate, then you have direct savings because of your good financial discipline, and that would really add up to your, like, significantly in terms of the amount that you save. And the third thing is that sometimes banks also run offers that if your score is good, they might be willing to give more discounts on processing fee. You might have better negotiating power. If you're already on the borderline and you apply to 2 housing finance companies and only one approved, then how would you negotiate on any of the terms? But if you have offers from two of the best lenders in the market, and both have approved your case because your score is 800, your profile is really good, then you have an opportunity to negotiate. Even if you save few thousand rupees by negotiating, that's a value add to you. You will be able to use that money to invest in your house and many other things that you have planned in your life.
Right, right. Excellent point. So you're basically saying ki have a very good credit score, apply for multiple apply at multiple banks and pit them against each other. Let them figure out who's the best customer.
That is right. That is right. That's how, like, if you are the best customer, then lenders would line up for you, right? The banks would line up for you. They would want your business. So why not take that position and take the benefit of it? But mind you, I think one important point there is that don't go and apply to 10 places. Like we discussed, if you
Right,
apply to 10 different places, that means 10 different inquiries would happen on your credit score, and that would be negative. So whenever you are assessing or applying to lenders, one of the critical points is to identify which lender to apply to. So if your score is more borderline, and most of the lenders publish their eligibility criteria on their websites, or if you're applying through an advisor, maybe it could be HomeCapital, it could be any other kind of advisors that you may have, agents which actually help you apply for home loans. They would tell you that if your score is so and so, your profile is so and so, these are the lenders who are likely to approve your home loan. So you just pick up
right.
two or three of those best lenders and apply to them, not apply to everyone.
Excellent point. I mean, good you clarified that. Otherwise, we would be having applicants who are applying at dozen banks and basically ending up with a very bad not negative, but a very bad score within a short period of time. Now, we've already pitted the banks against each other. Now I'm going to pit the credit bureaus against each other. I saw that there are four credit bureaus in India, right? So how do I ensure that? So basically, how does the bank or the lending partner decide which one to use to underwrite the loan? Basically, as a customer, how do I keep track of four different credit scores? Because I wouldn't be knowing, right, that which credit bureau the lender will use. So how does that work out, and what's the difference between the four in general?
So four credit bureaus are there, like in every industry, you need competition. So there are four credit bureaus providing nearly similar services to the lenders as well as to consumers like all of us. Now, the technology, the algorithm, the data science that gets applied by each of these credit bureaus is proprietary to them. And therefore, the
Right,
scores that they generate using the same data of the same customer could be slightly different. But principally, they all operate on the four factors that we discussed: repayment behavior, credit utilization, debt mix, and the number of inquiries that are done by a customer. So, what one needs to look at is that whenever you are checking your credit score, you can do it on a round robin fashion just to make sure that if you are checking your score every quarter, maybe in January you check it from bureau A, in April you check it from bureau B, and so forth. That would make sure that you are tracking all the four credit bureaus. You don't know as a consumer which bureau the lender would use where you are going to apply for a loan. And these banks and NBFCs, they also keep changing their policies. Today they might be using Bureau A, but few months later, maybe in January, they revisit their policy and they start using Bureau B. They have their own analytics units which apply a lot of uh, uh, comparisons. They choose bureaus for various reasons in terms of the quality of service, the quality of report, the data, and obviously the pricing that they get. But as consumers, we don't need to really worry about which bureau the lender would use. What we need to ensure is that our data, our information is up to date in all the four credit bureaus. And RBI since 2017 had recommended that every customer can check credit score and credit report from each of the bureaus once for free in a calendar year. So which means that if you start using all the four bureaus, just check your credit score once in a quarter on a round robin fashion. You get four credit reports free in a year without having to worry about and making sure that your information is up to date on for all the four bureaus.
Understood. So that brings me to my next question. So let's assume I'm going for a home loan and my CIBIL score is much better than, let's say, Experian. Then in such cases, is it possible for me to tell the lender that, hey, my score at Credit Bureau B is better than A? So is it possible for you to consider that? I mean, does that work out?
Usually not, usually not, because like I mentioned, a bank has or like a housing finance company, typically they have a policy which is centrally approved by their leadership, and usually it is also approved by the board. And whenever it is done, they make a choice in terms of which credit bureau they want to use and for what reasons.
Hmm.
So if it is like, say, for example, in the example that you gave, if they are allowed to use CIBIL and Experian, and maybe your CIBIL score is slightly lower and Experian score is better, then the bank or the housing finance company might be able to use. But if the board policy does not approve usage of, say, Experian, it just approves usage of CIBIL or maybe the other credit bureau, in such a case, then like consumer will not be able to have a say. But the point is that if you are making sure that your scores are above that threshold, then one should not really have a cause of worry.
Ah, understood. Now, my final question would be, so I was actually asked this and even I did not know how to answer that. Let's assume I took a loan today, a home loan today, and 3 years down the line, I couldn't pay off a few credit card bills, and my credit score basically took a massive crash. So, in such cases, if I have basically gone with, let's say, floating rate for my home loan, does that affect after the sanction and after the dispersal has been done? Does the model change?
See, today, if I have to talk about today's situation, there is no general practice of looking at your drop in credit score having an impact on your interest rate. Interest rate movements would happen depending on how the RBI revises it. But in general,
Right.
today's market practice is not to revise the credit or the interest rate depending on how your credit score has performed over the years. But with the advent of data and technology, it is possible that in coming future, banks may start practicing it. So therefore, just getting a loan approved is not the only important thing. One needs to make sure that this discipline that we spoke about over last 20 minutes is something that
Right.
everyone should practice. And yes, there could be unforeseen circumstances. There could be difficult situations. Last 2 years have been tough for many, many people where truly their primary income got impacted because of which they were not able to pay on their credit card dues or loans. In such cases, either government comes out with schemes which allow moratorium or some sort of benefit for impacted people, or as consumer, if your intent is right, if your heart is clear, it is always better to reach out to the banker, tell them your problem, tell them your constraints, why you are facing that financial difficulty. And at least I have seen bankers also to be very empathetic and they are able to help provide some sort of structuring or restructuring so that the consumer is able to pay off and become a regular consumer. So, and if you are not able to understand the financial nuances, then just go to someone who could advise you financially. Maybe it's a professional or someone in your family who could give you the right advice and work on that. Just don't sit quiet, hide yourself under the blanket and think that everything will be hunky dory. That's not going to be the case. One needs to really take control of the situation, especially on the financial piece. Whatever mistakes that you may have done, even if you ignore it, it's going to haunt you few months later, few years later, whenever you are going to apply for a large loan again. So this dent, if you actually miss the payment, is not just going to get wiped off automatically. One needs to really work on it and make sure that that stays clean.
Right, right. I think you've perfectly answered all of my questions. In the audience, I think someone has asked if I have a credit card and not used it for 5, 6 months, will it impact my credit score? And the follow-up question is also that what happens if I close a credit card with all payments made? How does that have an impact on the credit score?
So, say if you're not using your credit card, that is by itself not a negative thing, because one could have a credit card but may not really have a reason to use it. But it depends on different scenarios. For example, if I was a borderline case on credit score, maybe my score was just about 700, and if I'm not using my credit card and that was the only credit product that I have on my credit profile, then bureau or credit bureau is not really getting any new updates on my financial behavior, because that was the only product and that
Right,
product is not being used. And in such case, the score might start to drop because of no update available to the bureau. And you might, because you are on 700, suddenly you might go to 680. And 6 months later, when you have to use something or you have to apply for, say, a home loan, your score might be 680, and then you are losing those benefits that we spoke about if you had your score maybe above 700. So that's the possible scenario. But if you are, say, sitting on 800, you're not using your credit card just for a few months, you are traveling abroad, or you may not have any situation where you want to use your credit card, that's absolutely fine. By itself, it does not have a negative impact on your credit score. And the second part of it is, if suppose I have two credit cards and I'm closing one because I'm not using it, I'm not liking it, I can always close it. It by itself again does not have an negative impact on the credit score. It might have a mild impact because the numbers on my credit profile will change. The limit was 3 lakhs. Suddenly that 3 lakhs will become zero on this credit card. So it will have some mild impacts, but nothing major that would really cause a worry unless you are in the borderline case. What generally is recommended is that if credit card was your oldest credit card and that was your first point that you entered into the credit world, and generally, like, say,
mm,
if I started getting employed, that might be my first credit card, and I've been using it, say, for 2 decades now. And if I close it today, then my active history of that credit card really gets lost, and that could have some impact on the score. Again, these are not major cause of worry. You can take your decisions depending on where you are. If you are on the borderline, then I would recommend that you continue with your oldest credit card and close maybe a new credit card if that is possible. But if you are sitting comfortably above 750, then I think this question could be pretty moot.
right, right. Actually, I just came across one last question, which was so I had faced the same problem when I was much younger and I wanted to avail a few buy now, pay later services, but I realized that I don't have a credit score because first I'm a student. In such cases, when someone doesn't have a credit score, what is the right way to get started? Because it becomes a chicken and egg problem. You know, the banks basically say we can't give you any service because you don't have a credit score, and you don't have a credit score because nobody is actually lending or providing you credit. So what is the best way to move forward in such cases?
I think the world has changed. So from the time that I think you may have faced this situation. Today, because of advent of fintechs, we have many players who are actually providing early stage credit to what we call as new to credit customers who do not have any credit history. They are the first timers. And in the bureau
Right,
parlance, many people would talk about it as -1 or no history customers. So BNPL, which is buy now, pay later products, are pretty commonly given to customers who do not have credit history. If you are buying a smartphone and you take a consumer loan from Bajaj Finance, you can get it approved for even if you are new to credit. If you're taking a two-wheeler loan, that could also be available to new to credit customers. So these are products that are typically meant for first timers. Getting a car loan or like a large housing loan, if you are a first timer very early in your age, becomes difficult unless you have a co-borrower who has maybe a better history.
Right.
Another possibility, like especially if you're looking for credit card as a product and you don't have, you're not getting credit card because you do not have history, is a secure credit card. What that means is that you open a fixed deposit with a bank, suppose that is of 50,000 rupees. You might be able to get a credit card with a limit of 30 to 40,000 rupees against that fixed deposit. You can use that credit card to make your online purchases, do that repayment of expenses on time. And once you do that for 6 months, your credit score will start to build in. And once you reach a certain threshold of your credit score, then if you apply for a regular credit card, you should be able to get that. And then you can, of course, think about closing down your secured credit card. So that could be an approach
Hmm.
also for people to start building their credit history.
Right. Right. Uh, there's just one question in the audience. It's basically, let's say I have 7 credit cards. One of them is primary, and rest are only to avail offers of a limited use. How should I basically navigate my credit score in such cases?
So, I think for people who have good scores, they tend to get more credit cards, and they may have like very similar practice where they have one or two credit cards that they use for primary purposes, and the rest they will use only for specific offers. By itself, again, there is no direct impact of that to credit history. What credit score would look at is the collective credit limit that is there and how much of that you are using. Now, that is one aspect. But also the second aspect is that if you're applying for a personal loan or if you're applying for a home loan, somebody would look at how much credit limit you already have. So if your income is not justifying that kind of credit limit that you already have, then the limit that they offer you on home loan could be slightly lower. So if you're not really using those credit cards, if you do not want that kind of limit exposures, it does not necessarily make sense to have all of them available, especially if you are going for a larger ticket loan, because your limits may vary. And there is a concept in credit assessment called debt to income ratio. So a banker would typically look at how much debt possibilities that you have, including the credit card limit, including maybe the outstanding on your two-wheeler loan or your car loan, to the income that you get as a disposable income every month. And that is what they try to look at when they approve, say, a home loan of a certain size. So if you have too many credit cards, which collectively take the credit limits to very, very high numbers, that could potentially have some impact on the limit or the disbursed amount or the sanction amount that you get on your home loan. So that's, I think, something that one should be careful about. But otherwise, there is no direct impact on your credit score.
Ah, understood. I think that answers all the questions. Okay, do you have time for one more question? There's one more. This
Yeah.
will be the last one. Uh, does maxing out your credit card and repaying it on time affect the credit score?
That does. That does. Which is what I think maxing out means that you are using your credit card to the limit. And that is what I spoke about as utilization on your credit card. And that
Right.
has like 25 to 30% impact on your credit score. So if you do it once, that is not bad. Say, suppose my credit limit is 1 lakh rupees and I want to buy an iPhone worth of 1 lakh rupees. I might max out this month. But what is important is that a practice that I'm showing on my credit performance over last 12 months, over last 24 months? Is that a consistent trend? If it is so, then it will have consistent negative impact on the credit score. For once,
Right.
during festival times, during maybe a special event like marriage, or if you're traveling abroad, there might be situations where you are maxing out your credit card. That by itself is not a problem. It's about the average of your credit utilization over a period of time that matters more.
Understood. I think, yes, you have answered all of our questions. Thank you so much for removing out time and joining us for our first webinar for the Home Buyers Connect series. I'm really happy to say that we'll be doing a lot of these in the coming months, especially for home buyers, covering the home financing ecosystem. Thank you so much for joining us today, Parijat, and I hope I see you sometime soon.
Thank you very much for inviting me here. It was really great experience for me, and I hope I could really add value to the listeners here.
For sure. See ya. And
Okay.
guys, thank you for subscribing to our webinar series. We will be doing this on a monthly basis. You can follow us on our social accounts at Facebook, Twitter, Instagram, or LinkedIn. We also constantly keep publishing new informative articles on our blogs. So you can also have a look at that, which will help you answer a lot of questions that might pop up in your home buying journey. Thank you so much, and we'll see you again next month.
And I hope the listeners make sure that they have good credit scores before they buy a home and take home loans so that they get all the benefits that we spoke about.
Sure. Done. Thank you.
Okay, see you. Thank you.
Bye bye.
Bye-bye.